Good evening, everyone. Welcome to our Bay Area Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. So tonight's class, we're going to teach a little bit about home buying and what that looks like for you. We're going to dive into quite a few different things, including different first-time homebuyer programs that are available to you as first-time homebuyers. We really try to make this an interactive session, so we encourage using the chat feature, and we're going to go and answer questions live on air as we roll through tonight's content. So we'll have plenty of a chance to exchange questions as we go through tonight's material. Let's talk a little bit about, actually, before we go over kind of tonight's material, let me just tell you a quick little bit about me. So I work with American Pacific Mortgage, and we get a chance to teach these classes all across the state, and for actually different states as well. But they're more designed around first-time homebuyer programs. And so we partner with Cal Hfa, which is the California Housing Finance Agency. So you're going to learn a little bit about some of those resources that are available to you as first-time homebuyers, as well as specializing in kind of various loan products like conventional loans, FHA loans, VA, some of the USDA products as well too. So, and we'll talk about some of the characteristics of those programs tonight. Here's tonight's talking points. So we're going to look at the housing market, both from like an interest rate perspective, as well as kind of what's going on with the housing market. A lot of great things to talk about, and kind of how things are kind of shaping up around the market, and really presents a huge opportunity for first-time home buyers. Then we're going to look at, in fact, we're going to move into the does buying make sense, and kind of doing a rent versus buy analysis with all of us tonight. We're going to look at credit and how that can impact your qualifying. We'll spend some time looking at student loans, and what as a lender, how do we kind of look at student loans and how those can change what we're eligible for with our loan programs. And with those loan programs, we're going to look at the different options that are available to you: conventional loans, FHA loans, VA. So we'll kind of talk more about the characteristics and the qualifying for those. We'll look at qualifying income with some of the documentation that you'll typically need in pursuing home ownership. We'll talk about those down payment assistance programs. We'll look at some of the CalHFA products, including the Equity Builder program, as well as some of the moderate income programs like the My Home Assistance. And then finally, we wrap up tonight's discussion looking at the process of buying a house. So we'll look at the 6 steps of home buying. What does it look like to go from a consultation, which is a one-on-one with us, to getting pre-approved and going out on your home search, all the way to getting the keys to your house. So we'll kind of walk you through what that process looks like. And we'll also kind of take you through what a consultation and kind of have a pre-approval is generally structured for you as a buyer. So let's go ahead and dive in. And we're going to first of all start off kind of as looking at the benefits of owning a home. So this is so much different than, our current position of being a renter, because this is going to be an investment we're going to make, and hopefully this is an investment that's going to get a chance to pay off over the course of you owning this home. It's probably going to be one of the largest investments you make in your lifetime. And some of the benefits that come along with owning a home is stability in your housing payment, and you're able to control more of your housing budget, right? So no longer are you waiting on the landlord to raise your rent once you decide to renew your lease. You have the ability to be able to pass along the assets to this asset to the heirs of your estate. You have growth of equity. Equity is created by how much you owe on a house, so your mortgage balance versus what the market value is of the home. And there's still some great tax benefits that come along with owning a home, like the potential deductibility of interest. So when we're comparing like renting a house or renting a condo or an apartment versus owning, it's always great to kind of dig in a little deeper and start kind of putting together like a budget. So we're going to spend some time looking at a rent versus buying calculator, and this is brought to us by Freddie Mac. And what this tool is going to allow us to do is to look at if we continue to go down the pace of renting versus what could it look like if I decided to take that steps towards ownership. And I know a lot of you that are joining us this evening are calling in or connecting with us through different parts of the state. Some of you may be in the Bay Area, maybe in the Central Valley or Sacramento area, or even in Southern California. So we're just going to put a general scenario up on the board, and then certainly as you have time, you're going to get a chance to do your own calculations. In fact, we're going to send all the material from tonight's discussion to you tomorrow morning. So when you have some time, you can kind of go through your notes from today's discussion and then run the calculations yourself. So I'm going to go ahead and start off with just kind of a monthly rent. We're going to say $2,500 a month in rent. I know that varies based upon where you decide to rent, or the location that you're at in the state. We're going to assume monthly renter's insurance of $15 a month. And then the other assumption we'll make is that our rent's going to go up 3% every year as we renew with our landlord. And then from a home purchase perspective, we have $500,000 plugged in now. We could even, maybe kind of try to boost that up a little bit, maybe to 550. For depending on where we want to buy in the market, that could be a condo potentially. But the minimum down payment, if we purchase at this level, is 3%. Now, we're going to learn a little bit tonight about some of the assistance programs that can help kind of close the gap for that minimum down payment. In fact, even help you put more than 3%, up to 10% down towards your down payment. But for just discussion purposes, let's go ahead and plug in 3% for this scenario. And then we also want to assume property taxes. Property taxes we calculate at different levels based upon where our home buyer is going to be purchasing in the state. If you're purchasing in the Oakland area, for example, taxes tend to be a little bit more expensive in the Oakland, Alameda area, as opposed to maybe if you're looking in the Sacramento markets. But we're going to go ahead and plug in $6,250 for our tax calculation here. Homeowners insurance, we're going to use $1,000. And then we want to factor in maintenance on our property, which we put at $1,500 annually. And then from a loan information perspective, we're going to put in a 30-year fixed mortgage for now. Average interest rate right around 5.625. We see that kind of changing day to day. I'm going to spend some time talking to you about rates in just a few minutes, but right now we're about 5.625. And then when you work with a lender, you do have origination charges. Those typically are processing and underwriting fees. For American Pacific, our processing fee is $910, and then we have a $995 underwriting fee. If you're part of one of our partnerships, which we're going to talk about later on, we actually discount those services by $750. So that's a really cool benefit if you're in membership with some of those different partners that we have. And then when you purchase a home or you utilize financing, whether it's purchasing or even refinancing, there's a thing called discount points. And discount points allow you to take a lower interest rate. So let's say I really want to get lower than 5.625. You can pay additional costs to lower the amount of interest that you pay. 1 point is generally equivalent to 1% of your loan amount. So if I'm financing $300,000, 1% would be $3,000. Now, 1% in additional costs, generally speaking, you can anticipate that to lower your interest rate roughly about 0.25%. So instead of paying, 5.625, maybe I'm paying 5.375 for my interest rate on my financing. And then other settlement charges, we're gonna increase that quite a bit. So other settlement charges are going to be title, escrow, and those are things that are going to be some of the third-party costs that you have in purchasing a home. Usually closing costs that we want to budget for are going to be anywhere between 2 to 3% of your sales price. I would say more towards the 3% level is what we'll generally see with most home purchases. And then the other assumptions we want to make is appreciation for our home. Let's hope it doesn't depreciate, but we're going to say appreciation of about 3% annualized. Expected time in the home, we're going to say 7 years. And then the cost of selling our house. Now, one thing that it's really helpful to know that as a buyer, when you have the representation of a realtor, there's no cost to you as the buyer. Those commissions that a realtor earns by selling you a home are paid for by the seller. Now, when you turn around and sell your home, hopefully, let's say in 7 years, as we're modeling here, then you would incur those costs at that time. So that's why we're going to plug in like 10%, given realtor commissions, closing costs for the sale of your home, let's say at the end of 7 years. And then we're going to put in state and federal taxes as well as a savings rate of 1%. So what this calculator comes back to us and says, if we go ahead, let's look under our payments tab here at the top. So if we're going to continue to pay rent at $2,500 a month, we know kind of what that's going to be as the landlord continues to increase our rents. If we decide to go down the path of home ownership, we're looking at a much higher payment because we have to factor in principal and interest based upon current rates, taxes, insurance, mortgage insurance, which we're going to talk about a little bit later. That total payment is $4,300 a month. So that's certainly going to, take us up higher than what we're currently paying right now. But when we stack side by side renting versus buying, and over the course of 7 years, that's an opportunity of about $44,000 by buying instead of renting. And how we get to that number is the tax benefits that still come along with owning a home, as well as the appreciation in a home. So no longer are we paying the landlord's mortgage, we're paying into our own mortgage, but hopefully reaping the benefits of appreciation. Okay, so that's our rent versus buying calculator. Again, we're going to send all this material to you tomorrow morning so you can take some time to do your own calculation and see what that looks like for you. Okay, let me go ahead and get us back into our slideshow. And now we're going to talk a little bit about the housing market, specific to kind of the Bay Area for this slide. And this is kind of taking a look at what's going on in housing appreciation. And the Bay Area is kind of an interesting test case when we look at what's going on, because especially over the last 2.5 years, it's been really hard for first-time home buyers to enter the market, especially the Bay Area market. There's a lot of like larger down payments. And so, we have buyers that may be paying cash at times or just significant 30, 40, 50% down payments. So it does make it difficult for a first-time home buyer to enter the market. But what we're seeing, especially in the last month and a half, 2 months, is sellers or more simply, they're more receptive to seeing what first-time home buyers can offer on their homes. And that's opening up the market to something we didn't see in the last 2.5 years. And this slide kind of illustrates what we're seeing in the changes in the market. Now, this gray bar represents the start of the pandemic. And, what led to this rapid increase in home prices is a few things. We saw lower interest rates, historically low interest rates, 2.625% interest rates. We saw a work environment that had changed for buyers. Instead of going into the office in the city, now we can stay at home in Walnut Creek and be able to work remotely or work out in the valley. So that changed things quite a bit. And then we saw just less inventory available on the market. So if we think about it, less inventory, super high demand because we have lower interest rates, different work environment, really pushed prices up. And that's why we saw this really steep trajectory in appreciation. Now, what's interesting as we look at this slide is we're starting to see this curve a little bit, which we're starting to see a little bit of a flattening. In some cases, we're seeing things kind of slide a little bit, not significantly, but it's certainly at least flattening. I would consider this more kind of a softening in the market, more of a recalibration of what we've seen, because the pace that we were on with this type of appreciation was not sustainable. So with interest rates starting to rise, especially over the last 4 or 5 months, it's starting to kind of calm down the markets a little bit. So more of our move-up buyers are not entering the market as much. However, our first-time home buyers are very prevalent in the market. And I think that's really where there's an opportunity, if it makes sense for a first-time home buyer to start kind of examining what the options could be for you in purchasing your home. Now, as I mentioned just a few minutes ago, interest rates played a big role in the last 2.5 years of velocity in the housing markets. And this is kind of what the rates look like. So this blue line represents the 30-year fixed mortgage. And as you can see, rates right about here hit their low point of about 2.5 to 2.625 is the lowest we saw. And then we saw rates kind of bump along a little bit. And then we saw this really swift move up here in the first quarter of this year. And you can see this big move upwards where rates moved up into the low fives, had a little bit of a dip down, and then we pushed right up against 6%. In fact, we were probably 6.1%. And now we've seen rates kind of come back down. And we'll remain in a very kind of choppy market. So rates are up one day, they're down the next day. So we're seeing a lot of volatility. What's playing into that is kind of what we're seeing with economic reports that are coming out. The jobs report that just posted on Friday was better than expected. So we saw interest rates take a bit of a hit on Friday. But just earlier in the week, we saw interest rates improve significantly. And that was driven behind what we got in feedback from the Fed Reserve meeting minutes that came out about the kind of state of the economy and the expected interest rate increase of 0.75%. Now, what's really important to know as you're monitoring what's going on in interest rates, as the Federal Reserve is uptaking interest rates, that's not a direct correlation with what you're going to see in mortgage interest rates. Because when the Fed raises interest rates, that's going to impact things like your lines of credit, your auto financing, your credit cards. So those are going to obviously change buying behaviors in the marketplace because of higher interest rates. Mortgage interest rates are going to be controlled more so by the bond market or mortgage-backed securities. And a good reflection or a good kind of a index to review if you're looking at what's going on with interest rates is to look at the 10-year Treasury. And the 10-year Treasury right now is below 3%. So if we can keep that below 3%, hopefully we'll see a little bit more stabilization when it comes to interest rates. The average interest rate now is kind of, it's bouncing around between 5.625. I know we have 5% on this slide, but that's, if we look at kind of the current market right now, we are right around that 5.5 to 5.625 level. Now, interest rates change based upon a few things. One is credit eligibility. So if I have a 740 credit score or better, I have an opportunity to obtain the lowest available interest rates. Loan products, whether it's an FHA or conventional loan, will change the availability for interest rates. How much I finance, how much I put down for my down payment. So if I only do 3%, that interest rate is going to look different than somebody that's putting down, say, 20% down. We talked a little bit earlier about the cost or discount points. That also can enable you to get a slightly lower interest rate. So if I want to buy down my interest rate, I can pay additional costs. And finally, term of your loan will play a role in your selected interest rate. So the shorter my term, so if I go from a 30-year fixed mortgage to, let's say, a 15-year fixed mortgage, that'll lower the available interest rate. Usually that separation from 30 to a 15 is going to lower the rate by upwards of 0.5%. Not typical with our first-time home buyers is to take on a 15-year fixed mortgage, because as you can imagine, that's going to almost double your monthly payment. So it really changes the budget and cash flow for a buyer. Now, one of the key elements to obtaining the lowest interest rate is obviously to maximize credit. Credit's going to influence not only our interest rate, but it's also going to influence a thing called mortgage insurance, which you're going to learn a little bit more later on this evening. Let's kind of talk a little bit about credit and how credit is weighted. And by the way, many of you that are joining tonight's session have credit monitoring, whether it's through Credit Karma, it's through Experian, Equifax, TransUnion. Those are all great tools that are available to you. Just keep in mind that the tools that you're using through those type of services are going to be credit card scores, and those can differ a little bit than a mortgage score. So we get that comment quite often, probably at least once a day, where a client has a 650 credit score on Credit Karma, but maybe it's a 620 with the mortgage score. So you just kind of keep that in mind as you're looking at your availability for mortgages. Experian offers the mortgage score. So if you decide to get membership with like an agency like Experian, they have access to for the consumer mortgage score. So that might be something you want to think a little bit about. The FICO score calculation is weighted as such, and it's off to the right over here. So 15% is going to be how long I've had credit. So the more mature my credit file is, potentially the higher my credit score could be. 20% is going to be how long I've had credit in use, or how much new credit I'm trying to obtain, really. So that's going to be also known as inquiries. So if I've added a lot of new accounts recently, especially in the last 6 to 12 months, and those also create inquiries, hard inquiries on your credit, then I could impact negatively my score. Now, speaking of inquiries, when you start the process with our team, we actually start with a soft credit score. And the benefit of doing that is a soft score doesn't impact your credit score. So it gives us visibility to your Equifax score, whereas most will pull a hard inquiry to begin the mortgaging process. We want to make that as easy as possible for you. And then certainly we can give you some options by looking at that soft score. But a hard inquiry can put an image on your credit report and potentially lower your score. Soft inquiries just give a lender visibility to it. Eventually, we will need to do a hard inquiry, but upfront is just the soft. Now, there is a rule in mortgage financing and auto financing. That is that once you do your first hard inquiry, you have a 30-day window of time to shop around with as many lenders as you like. And that's the equivalent of one credit inquiry hit to your score. So once you have that first credit inquiry, hard inquiry pull today, then you have that 30-day clock to look at different options with various lenders. And then 30% is going to be how much I owe on my credit debt. That's also known as credit utilization. Simply put, if we look at, if I have a $10,000 credit limit and my balances are at $5,000, that means I'm at 50% utilization. Ideally, we want to be below 10% utilization in trying to optimize our credit score. And one way of really trying to manage your credit utilization is trying to pay down or maybe even pay off our credit cards before the end of our billing cycle date. So if you kind of take a look at your credit cards this evening, you have two dates. You have a billing cycle date and you have a due date. If the due date's on the 4th, and let's say my billing cycle is on the 20th, the 20th is the date that the credit card issuer is sending out the data for your account to the credit bureaus, all three of them, TransUnion, Equifax, and Experian. And that data gets received by the agencies, and then they report that balance. Now, if you're in the habit of paying off or paying down your balance on the 4th every month, the drawback to that is that balance is posting on your credit bureau and then lowering your credit score. However, if you get in the habit of paying down or paying off the balances before the 20th, your billing cycle date, then you'll have a much lower balance, improve your utilization, and hopefully have a better credit score. Okay, so that's just one way of kind of managing your credit account, because that's a third basically of your credit score. And then the remaining amount is how I've paid my bills. That's also known as payment history. That's 35% of the weighting in your credit score. Payment history is looked at in 30-day lates, 60 and 90-day lates. And so if we had some challenges on some of our accounts, especially in the last 12 to 24 months, those are going to be the most impactful to our credit score. Things like bankruptcy, short sales, collections, late payments, again, when those are in the last 12 to 24 months, that's going to be the most impactful to your credit score. And then account closure is something we want to be careful with. If you're in the habit of balance transferring to get different credit card benefits, just be careful that you don't close out the previous credit card, because it can actually lower your credit score because you lose a credit card that's part of your utilization of credit. So you get a lower overall credit limits that are available to you. And then from a length of credit perspective, by closing out that credit card, you could hurt your length of credit, because if that's one of your older, more seasoned accounts. In financing, we look at obviously the 3 credit scores. So like I said earlier, TransUnion, Equifax, and Experian. We always take the middle score of those 3 agencies. So if I'm at 740, 720, and 700, for financing, we're going to take the 720 credit score for qualifying. Now, I have a 720, but let's say my partner has a 680, 660, and 640 score. The 660 score is going to be what we use for qualifying, because we always take the lowest middle score between the 2 applicants. Okay, so just something to keep in mind. And why that's really important, it impacts your program, your interest rate, obviously your closing cost potentially. So those are things that we'll kind of talk through as part of a consultation with us. Finally, just as we kind of wrap up on this slide here, to the left, you can see the minimum credit scores by product. So 580 for FHA, 620 for conventional, 620 for VA, and then the CalHFA first-time buyer assistance program has score ranges from 640 to 680. So when we look at our credit, and especially kind of the past challenges, it's important to know kind of how long they've been on, or how long they're going to remain on your credit report. So most things are going to stay on for 7 years, especially late payments and collections. Inquiries are going to be on your report for 2 years or less. Those are the hard inquiries. Public records, bankruptcies, tax liens, those are all going to be on your credit report for 10 years or less. And then federal debt can be on your credit report indefinitely. So that's something we really want to kind of wrap up. Now let's talk a little bit about student loans, because that's an important element to qualifying. Those of you that do have student loans, there's a couple different ways that we look at those from a qualifying perspective. The first thing is, if right now with all of our federal student loans, because of the pandemic, they're all on forbearance. So you have a 0 payment that will generally show on your credit report. However, as lenders, we do have to count a minimum payment for you in qualifying. There's 2 different looks at it. So on a conventional loan, we take by default 1% of your balances, however, or for your monthly payment. So if I have, let's say, $75,000 in debt, then I'm going to automatically by default count a $750 payment. But if I'm on an income-based repayment amount, I only count that income-based repayment amount, which is, let's say, $250 per month. If it's an FHA loan and we have that same $75,000 in debt, it's 0.5% of the balance that we take for the monthly payment. And then if you're on income-based repayment amount, then we would take that amount. So let's say $250 as referenced in this slide. So that's pretty important, because even though they show it as in forbearance right now, we still have to count that payment factored into your what we call debt to income ratio. If you're back in school, they're probably in deferment, but we still have to count a monthly payment against you for qualifying. Even if you're in a forgiveness program, there's still a payment that we have to apply for the qualifying. Okay. Any questions on student loans? Because that comes up quite a bit during our sessions. Anything I can help answer for our audience on that? Okay. All right. And again, this is, open format. So if you do have questions as we roll through tonight's content, please feel free to use the chat function, and I'll get those questions answered for you on air. Okay, let's go ahead and transition to different loan programs that are available to us. And these are kind of 5 of the core programs that most of our first-time home buyers are going to utilize. There's the conventional loan, FHA, VA loans, USDA, and jumbo loans. So those are kind of the 5 core programs. More often than not, a first-time buyer is going to utilize the conventional and FHA loans. So we'll spend some time looking at that in just a minute. I want to comment on jumbo loans, which for our Bay Area markets, those are for loans that are above 970, 800. They do require a much larger down payment. Generally, it's 10 to 15% down for home buyers. And there's an important characteristic with jumbo loans. Not only do you have to contribute your down payment of 10 to 15% plus your closing costs, anywhere between 2 to 3% of your purchase price, but they also require what we call as reserves. And reserves are assets that I have in my brokerage account, CD, checking, savings. They don't necessarily have to be liquid accounts, but reserves are money that I have left behind after I've contributed my down payment and closing costs. Usually it's 12 months times my monthly payment. So if I have a monthly payment of, let's say, $6,000 a month times 12, that means I would have an additional assets of, say, $72,000 left behind. So USDA loans just above that, that's for our rural areas. So those of you that are joining us from the Bay Area, that's going to push us further, probably north into like the Winters area, maybe further out. You're going to have to probably get out of the Bay Area because it's going to be more less densely populated areas. But those loan programs are 0% down options for clients. VA loans for our veterans that I've served, those are eligibility of 0% down as well. And they can go $1 million plus 0% down. So really a great option for our veterans. Now, specific to conventional and FHA loans, the minimum down payment on a conventional loan up to $647,200 amount financed is 3%. Now, oftentimes, especially in the Bay Area markets, even our Southern California markets, we're going to go beyond the $647,200 mark in financed. So then that minimum down payment jumps from 3% to 5. And that amount financed goes all the way up to $970,800. Okay, so that's for a conventional loan. Now, the minimum credit score for conventional is 620. For our FHA loan, just below that, minimum credit score is 580. Now, with FHA loans, whether you finance $100,000 or $970,800, the minimum down payment is 3.5%. Let me jump back just for a second. I want to just give you some terminology on the conventional loan. So when we go beyond 647,200, the space from 647,201 to 970,800 is called high balance, or sometimes it's categorized as super conforming. So that is a designated space of amount finance for clients in the community that are trying to purchase in high cost of living areas like the Bay Area. Okay, so that's called super conforming or high balance. Now let's go back to FHA. So it's a minimum down payment of 3.5%, regardless of how much you finance with FHA, minimum credit score of 580. So most of our first-time buyers are going to usually elect either a conventional loan or an FHA loan. Okay, now, as it relates to mortgage insurance, that's an important component of designing financing for our clients. And conventional loans look at mortgage insurance differently than FHA loans. And mortgage insurance generally comes into play when we put less than 20% down. I'm going to just pause for just a quick second. We had a question that came in. Okay. So I'll just kind of answer this question in general terms. So a question came in, if we put less than 3.5% down on an FHA loan and we become underwater, if the real estate market switches, we may need to sell our house. I mean, I think ultimately, for all of us that are joining tonight's call, you know, if we are going to put a minimum amount down and the market does change on us, that's something we have to factor in. So the less investment we have, obviously that's going to change our equity position. So I think that's something we all have to kind of consider as first-time home buyers investing in the market. To answer your question though, around real estate crash, we don't see any type of crash per se on the horizon. This is a much different market than what we saw in 2007, 2008. Back in those days, you had lenders that were making, unfortunately, just really bad loans to buyers. Thank goodness that's not something we offered at the time. But I think you have fully qualified buyers, and we have inventory challenges in our market, which is still the other thing. We still need more inventory on the market. Back in the crash days, we had less inventory available and just not very suitable products for clients. So another question came in on product. So if we have someone that's had a deceased father Can they utilize the VA loan? So generally speaking, the VA benefits would not pass along to a child for financing. It usually has to be a spouse for the VA loan benefits. Okay. All right. Thanks for all these questions. We appreciate it. Okay, let's talk about PMI. As I mentioned earlier, when we put less than 20% down, you're going to have PMI. So when we look at conventional loans, there's a couple different ways of paying PMI. So it can be done monthly. It can be split between monthly and upfront. There's single premium where you buy out the mortgage insurance, and then there's lender paid mortgage insurance. And that's where we take a slightly higher interest rate to buy out our mortgage insurance. The most popular option that we see in designing financing for clients is the monthly MI. Because that enables a client, once they reach 2 years and have 22% equity in the home, they can apply to have the mortgage insurance canceled. So that's a really great option. Now, PMI is based upon your credit score, how much you put down, and then how much you finance. So the less you put down, so if we only put 3% down, the mortgage insurance is going to be much more expensive for us. So the larger our down payment is, the less expensive mortgage insurance will be. Let's take a look at what a mortgage insurance scenario could look like. So if I financed $450,000, for example, and my credit score was 740 and I had a minimum down payment of 3%, the monthly mortgage insurance is calculated at $183 per month. Okay, so that's for a conventional loan. Now, as you look at online calculators, maybe through Zillow or Redfin, those numbers are going to look quite a bit different. It's just because they're not calibrated like a real-time quote is how we put on our slide here. So because we're factoring in the credit score, the down payment, and the amount financed. It's more generalizations when you do like searches on Zillow and Redfin, and they offer payment scenarios. Now, when you look at FHA mortgage insurance is quite a bit different because on a conventional loan, if I put 20% down, I have no mortgage insurance, but FHA is much different. Whether I put 20% down, or let's say I put 3.5% down, which is the minimum, I'm still going to be required to have mortgage insurance. And there's two forms of mortgage insurance that FHA requires. One is monthly mortgage insurance, which is 0.85% of my loan amount. The other is upfront mortgage insurance, which is 1.75% of the loan amount. And that gets added on to my amount financed. FHA loans, it only allows you to cancel your mortgage your mortgage insurance through a refinance. So you'd actually have to obtain like a conventional loan and refinance out of FHA. So when we look at FHA PMI, the monthly PMI on that same scenario is going to be about $324 a month. And then we also have to add on the upfront PMI of $7,875 that gets tacked on to that $450 loan amount. So instead, I'm financing $457,875. So FHA mortgage insurance is quite a bit different. And I think there's a bit of a misconception around FHA because most people think that because I'm a first-time home buyer, I have to use FHA, and that's not the case. I mean, you can do conventional or FHA. The determination of whether I use FHA or conventional is really going to be around some of the guidelines for the different programs, including the credit score. As we learned earlier, the minimum credit score for FHA is 580 versus conventional is 620, and that difference may have a buyer look at one product over the other. FHA is much more lenient when it comes to past challenges like bankruptcies, foreclosures, short sales, maybe late payments, whereas conventional is going to be a little bit more strict. You know, foreclosures, you can't have one for 7 years versus FHA will consider it 3 years. Or let's say I had a bankruptcy. FHA will consider after 2 years, where a conventional would want to see 4 years. So those little different nuances within the guidelines are going to be a determining factor to see which makes the most sense for each client. So that's something we would certainly talk about during a consultation with you. Okay, now I want to kind of transition a little bit out of loan programs and now talk about some of the documentation and different scenarios when it comes to qualifying income. For our W-2 wage earners, generally, we're going to need the last 2 years of W-2s, last 30 days of pay stubs, and then during our process, we're going to verify employment. That's usually done via written verification of employment as well as a verbal verification of employment. For our self-employed individuals, it's going to be a little bit more document intensive because we're going to need not only just your personal income information on your tax returns, but we're also going to need the business tax returns. If you're like a LLC, S Corp, or C Corp, we'll need the 2 years of the business returns plus your personal returns. If you're a sole proprietor, Then you have what we call Schedule C income, and that's included on your personal tax returns under Schedule C. There'll be profit and loss statements that we'll generally ask for, balance sheets, and then we're going to need to verify the verify the business, whether that's through a business license, employment verification, CPA letter. Is kind of the things that we would generally ask for self-employed clients. Now, a few scenarios that come up in working with our clients in designing financing, and the questions we get is around some of the things like, for example, how long do I have to be on the job? So there's a big misconception that I have to be on the job 2 years in order to get financing, which is not the case. What we look for is 2 years work history and or education. So if I have 4 years of, let's say, undergrad, and I just graduated and now I've been on my job for 6 months, between my 4 years of, let's say, my accounting degree and my now experience in the accounting field of 6 months, that would meet my 2-year requirement. So it's not necessarily 2 years, it's being able to show that either I've been in the workforce for 2 years and or I've had education to support what my current role is. Another question that comes up often is if I have dual employment. So if I'm working at one company for 30 hours a week, another company for 20 hours, am I able to count both sources of income? And the answer is if I have 2 years simultaneously working both jobs, then I can use both sources of income because we want to show that there's sustainability or maybe stability more so in those dual sources of income. Now, if I'm working a full job, let's say 40 hours a week, and I also have side income and I'm working for Uber or Lyft, the Uber and Lyft income is Schedule C, sole proprietor income. I can count that, but I do have to show that I've been doing both jobs for 2 years. Another thing comes up is job transition. So if I'm getting ready to start a new job, let's say I currently work for one company here, but I have an offer to go work for a different company. As long as I can get a copy of my executed offer letter for my new job, those new wages can potentially be used for your qualifying. And the rule is, as long as I have an executed offer letter and I get my first paycheck before my first mortgage payment is due, then those wages can be used for your qualifying. Okay, any questions on income or some different scenarios that I can help you out with? Yes, looks like we have a question. Go ahead and type your question in the chat, and I can answer that on live or answer it on the air. Okay, so question is just what about how do we calculate income with couples with only one working person? So totally fine. We have couples that apply together, and if there's only just one source of income, that's fine. That one source of income is used to qualifying for the existing expenses as well as any new expenses, obviously with the new mortgage. We're going to talk a little bit later about first-time buyer programs and how that kind of impacts the income limits that are assigned to first-time buyer programs. So that'll be something we can revisit a little bit later as well. And another question that comes up sometimes is and it's not necessarily in the income space, but applying jointly. And I think some clients will get confused that do I have to have a certain marital status if I'm applying jointly? So there's no marital status requirement at all. You can apply individually, you can apply jointly. So there's no requirement of that. So when you apply jointly, your income and your partner's income or your co-applicant's income are looked at the same. So that income, those obligations, and what they are is they're combined into the equation of qualifying, and they're combined into debt to income ratio qualifying, which we're going to talk about in just a second. So that's something that comes up as we're kind of consulting with clients. So it's looked on equally. But with debt to income ratio, this is just a calculation that we use, taking your pre-tax income versus your monthly obligations, and we come up with a percentage of what your obligations are versus your income. Generally, we don't want your debt to income ratio to be more than 43 to 45% of your gross monthly income, especially your housing expense. We don't want that housing expense to occupy more than 45% of the pre-tax income. Housing expense just relates to the principal, taxes, insurance, PMI, Homeowners Association, if applicable, which in this slide would be reflective of this $2,500 per month. Now, debt to income ratio is a calculation we use as lenders to determine qualifying, but it's not necessarily affordability. So when we do a one-on-one together to design your financing, we're going to talk a little bit about where you're at from a rent perspective. Where do you want to be from a monthly budget perspective? And we want to make sure that we're designing options for you that are going to be, sustainable and affordable for you long-term with your home financing. So debt to income ratio is qualifying, not necessarily affordability. So a question came in, does military housing allowance count towards qualifying income? And so, yeah, it could potentially be counted for, should show up on your pay benefits. And so that could be potentially added to the application as well. Yeah, good question. Okay, so here's the debt to income ratio calculation. So the housing expense, we'll say, is $2,500 a month. If I have other obligations, like maybe student loans, a few credit cards, let's say it's $500 a month. And then if my gross monthly income is $8,500 a month, if I take that monthly expense of $3,000 versus $8,500, my debt to income ratio is about 35.29%. Some of our first-time homebuyer programs, which we'll talk about in just a little bit, maximum debt to income ratio is 45%. In consulting with all the clients we do throughout the day, most clients feel pretty comfortable around 33 to 36%. Now, we do understand also that things are a little bit more expensive these days, especially in some of our high cost of living markets, and maybe 33 to 36% debt to income ratio is not always doable for our clients. So we may be at the upper end of the debt to income ratio. Again, the conversation we really want to have is, what does affordability look like for you, and how do we design financing that's going to work best for you? Okay, so let's talk a little bit about down payment. There's usually kind of two main challenges for buying a house as a first-time home buyer. It's usually either credit, because I just starting off on my credit, or maybe I had some past challenges, or it's down payment and lack of resources. Now, we're going to have to verify some type of assets for financing, but the good thing is we're going to talk about assistance programs in just a bit that can help out with that. But certainly, if you've saved some funds, those can be used towards your home purchase, and those need to be all verified, usually through checking and savings accounts, if that's where your money resides. Cash deposits are not acceptable for home financing, so it has to be all something that could be paper trailed. If you've had any large deposits or you're doing balance transfers, we all have to paper trail that kind of stuff. Retirement accounts can be used not only just for assets for down payment and closing costs, but also for reserves, as you learned earlier. 401ks, 403bs, you're generally going to take out a loan against those assets. That's not always recommended. And I talked to clients to even today about it, that the market's down right now. So if you're taking loans out against your 401ks, 403bs, you're taking loans out against an asset that's actually lower in value right now, and then you're pulling money out of the market. So hopefully when the market recovers, you're losing kind of new equity that you could create in your account. So you definitely want to talk to your financial advisor if that's the best option for you. IRAs as well, talk to your tax advisor or your financial advisor, because there can be tax implications with IRAs. And then gift funds can also be used, and gift funds do not require any type of seasoning requirement. Most assets require 60 days of seasoning, where gift assets do not. And gift assets can be added on to assistance programs. They can complement your existing money that you have saved, and that happens quite a bit for a lot of our first-time home buyers. If your parents are willing to help out with $10,000 or $15,000 towards your down payment, that's all allowed through financing programs. And there's a way that we paper trail gift funds. Usually it's a gift letter completed by the donor. It's proof of the available assets, and then proof of the transfer of the funds. Okay. All right. And we're going to go ahead and now talk a little bit about assistance programs, because as I mentioned, saving up enough money for your home purchase can always be one of the biggest challenges. So there's a few programs that I want to kind of go through, and they're in partnership with CalHFA. So if you haven't got a chance to do some research on CalHFA, CalHFA is the California Housing Finance Agency, and we're proud to be one of the leading providers of this program. And there's kind of two different paths we can go down with CalHFA. There's the moderate income option. There's a low income housing option. And so we're going to first talk about the moderate income housing option, then we'll switch gears and talk about the low income option. And the first product solution is called the My Home Assistance Program, and that provides up to 3% of your 3% of your purchase price towards your down payment on a conventional loan. 3.5% of your purchase price on an FHA loan. And what that is, that's a low interest loan at 1% interest, and it's not required to have monthly payments made on it. You don't have to pay it back to the state until you either sell your home or if you refinance in the future. So it only, again, accrues 1% interest. It accrues as simple interest too, which is really important. There's another product option that can be added on to the My Home program. It's called the ZIP Assistance Program, and it provides 2% of your loan amount in interest-free assistance. And it does the same thing where there's no payments required on it. It's all deferred until you sell or refinance in the future. Now, when you go from the My Home Assistance and you add on the ZIP Assistance Program, there is an interest rate differential with the program. All the interest rates for CalHFA are set daily by the state of California. So when you work with a preferred lender like our team here, the rates are all set by the state. So it doesn't vary as other products do. So for example, today, the CalHFA moderate income product was 5.625% on a 30-year fixed mortgage, and that enabled moderate income buyers to obtain the 3% My Home Assistance. Now, adding on the ZIP Assistance would actually change that interest rate. It elevates it quite a bit. So those are things that we'll talk through in a consultation to see what the right design for you is as a first-time buyer. One of the great things about these programs is they're very lenient from an income perspective. So what we see on this slide here is the updated income limits as of this year by county in the Bay. So, we go up to as high as $300,000 with the income limits, and that's based upon just the applicant's income. Okay, I'm gonna take a quick pause there. There's a question that came in. Let me just read it really quick and I'll put it on the air. Okay, so the question is, for the CalHFA program, does the loan go to the down payment, or would someone have to have the down payment money first and then get reimbursed by the loan received? Okay, so great question. So what happens on the assistance program is, and I'm gonna show you guys a scenario in just a minute, where we fund the first mortgage as well as the assistance. So that all gets sent in for your overall proceeds to purchase the home. And we can kind of do a little bit more of an illustration of this when we go through the home buying process, but it would look something like this. So in the first, by the way, the first scenario that we have here on this slide shows if we bought an $850,000 house, 5% down is a requirement because now we're in a high balance loan. And then with closing costs, we would probably need about $67,500. So to answer that last question, if we bought the same property for $850,000, we would get 3% of the price of the home through the My Home Assistance program, and that would help to basically pay a good chunk of the minimum down payment of the $42,500. And then the ZIP assistance could also be added in 2 to 3% of the loan amount, and now it takes that eligible assistance to anywhere between $41,000 to $49,000 that can be used to offset some of this cash to close. And that's how we would fund the assistance program for you. So it's nothing where you would have to put the money out of pocket and then get reimbursed. Okay. Am I good on questions?
There's one for BH. Does that count as income?
Oh, sorry. Okay. Sorry, there's another military housing question. So yeah, so that same question about the military housing income, that allowance would count towards the income limit. So yeah, thanks for that question. Okay, any questions on the scenario here for the Bay Area? Okay. All right. Now there is eligibility requirements for CalHFA, as I mentioned earlier tonight. So the minimum score is 640. That's for an FHA loan. 660 is going to be for the low income housing product, which we're going to talk about in just a second. 680 for a conventional loan. So there's FHA and conventional that we can go down those paths with CalHFA. The maximum debt to income ratio is 45%. Now, one of the great things about this program, the income is based upon the applicants only, not the household size. So let's say I'm going to purchase let me say my income is, $150,000 and my spouse's income is $151,000. Well, that would put me $1,000 above the income limits if I was buying in Santa Clara. But if I just apply just in my name, then only my $150,000 would be counted towards the income limits. And now a first-time home buyer is someone that hasn't owned in the last 3 years. So that's where we there's a little bit of misconception there too. So if I sold my house in 2012 and I've been renting for the last 10 years, now I'm basically now considered a first-time home buyer. And this program is available for single-family homes. You can buy new construction with it, condos, townhouses, below market homes as well. They're all eligible under the program. Manufactured homes are a little bit different. It has to be on land that is owned. It can't be like in a park or anything like that. So actually, when it's on land that's owned, it's considered real property. Now let's talk a little bit about the low income option. This is where we have a lot of attention. In fact, many of you that are joining tonight's class may have heard about the Equity Builder program, and just through some of your online searches and connecting with our team. So the Forgivable Equity program allows a buyer to get up to 10% of their purchase price that can be used towards the down payment or closing costs. Different than the My Home Assistance program, this assistance is completely forgivable. So as long as you stay in the property for 5 years, it's completely forgiven. Now, the big difference here is the income limits. The income limits are much lower on this product because it's designed to help our low income families. So if you're in Santa Clara County and you apply and you make $133,280 or less, you would be eligible. All other Bay Area counties, it's $128,880. Now, the same rule applies, and this is where we see a lot of clients doing this, whereas if I have two sources of income, but maybe we're going to apply just in my name, then we could stay underneath the income limits that's allowed on this program as well, just like the moderate income program. It cannot be combined with the My Home and Zip Assistance program, and so it's a separate independent program that's just providing 10% of the purchase price, which is a significant amount. Now, as a buyer, you can add to the Equity Builder program as well. So rather than just putting 10%, let's say you want to add an additional 10%, you could put a combined 20% down on your house. Now you don't have mortgage insurance. So that's an option for you as well. At the same time, the maximum contribution from a buyer is 20%. So you can't put more than 20% between yourself and maybe family that's going to help you out, and then 10% from the Equity Builder program, which is a combined 30%. So if you have somebody that's really wants to help you out and you're going to have a significant down payment, it just can't exceed 20%, and then the other 10% from the Equity Builder to make up that 30%. Okay. All right. So we had another question that came in. If the house has an ADU, is it ruled out as a single family home? So the answer is no on that. So single family homes with ADUs are allowed. It's still considered as a 1-unit property. Any questions on the Equity Builder program? Okay. All right. We'll keep it moving then. That's a fantastic program. We're very proud to be a partner with Cal Hfa on that. It really helps service our communities with that. We don't have a scenario on the Equity Builder program, so we had a question that just came in on that. I mean, ultimately, let me kind of backtrack a little bit, and I can just I'll kind of verbalize what the numbers would be. So we're going to take the same conventional loan. Somebody asked us to show an Equity Builder slide. We don't have that, but we'll definitely make a note of that. We'll have that on the next session we do. So if you qualify for the Equity Builder, instead of getting, $25,500 for the My Home Assistance, you would have $85,000 in assistance that would count towards your down payment and or closing costs. So we would want to design a financing option to see what's the best way to leverage that $85,000 based upon where you want to qualify at. And then, as I mentioned earlier, you can add additional funds on top of that $85,000 to reach your qualifying. Okay. Did I miss a question?
No,
was it more? Okay. All right. Perfect. All right. Yeah. Thanks for that. We'll definitely add an Equity Builder slide to our next session for sure. Okay. Let's talk a little bit about the buying process. This is our 6 steps of home buying, and this kind of shows you the different milestones that you go through as a home buyer. The step 1 is going to be pre-approval, and that is kind of the output of a consultation with us. Now, there's a difference between a pre-approval and a pre-qualification. A pre-approval is all our team does, which is just, it includes your application that's been submitted, and we review that. We've reviewed your income, your credit, your assets, and we make sure you're fully verified. A pre-qualification, which is done by most online lenders, is just looking at your credit and your application, of course. So it's really important to have as much strength in your pre-approval, because it still remains that even though the market's switching up a little bit, it's still important to have a really strong pre-approval. And so that gets us started at step one in the process. The pre-approval is good for 60 days. We can always recertify your pre-approval at any time, but it shows the seller that you're fully verified for your financing. That's going to be a requirement of your offer submission. Step two is going to be house hunting. So that's where you get a chance to partner with a realtor and get a chance to see what's available in the market for you. Generally, you've probably started your search online, and then you'll want to partner with a realtor that'll show you different homes that are available in your price range. In working across the state, we have preferred realtors by geography. So if you want somebody that can help you in the Alameda market, for example, we have preferred realtors that work with us in those areas. Now, as I mentioned earlier, realtors are paid for by the seller. So we really encourage you to take advantage of that resource, whether you find someone on your own or you want to get connected through our network as well. The pre-approval is something it's fairly flexible. We can update pre-approval letters based upon what you want to offer on a home. So if I get pre-approved for $800,000, but I fall in love with a house that's say $750,000, we can always make those changes to your pre-approval. Okay, so we're out house hunting. We find a house that we love. Our realtor helps us design and structure an offer. We submit that offer to the seller, and guess what? The seller accepts our offer. So now we're going to move to step three in the process. That's called entering escrow. That means the seller has accepted our offer, and it starts the escrow time period. Usually from the acceptance of offer to the time you get your keys, it takes about 30 days. And there's no difference in timeline if you use an assistance program or not. That question comes up quite a bit. It's still going to work just like a normal conventional or standard FHA loan. So the seller has accepted our offer. We're going to give you a call within 24 hours of that acceptance, congratulate you, talk a little bit about next steps, and schedule you for your follow-up consultation. Now, you as a buyer will be required within 2 to 3 days to make what we call an earnest money deposit. That deposit is going to count towards your total out-of-pocket expense, but it's showing a good faith financial investment on your part. And we're going to talk about earnest money deposits in just a second. But when we do your follow-up consultation with you, that's going to be a video session that we do. We're going to go through all the structure of your financing, your interest rate, your payment, your out-of-pocket expense, understand more about your closing costs. At the same time, your realtor is orchestrating your inspections of the house. As a lender, we're getting your appraisal ordered, and then we're going to send your disclosures to you, which are called your initial disclosures, after we've completed your follow-up consultation. Now, an earnest money deposit it's a financial good faith deposit, and it tells the seller that you're serious about this property, you're making an investment in the property. It's usually, for most markets, it's 1 to 2% of your purchase price that the deposit will be. The Bay Area is a little bit different. It's about 3% on average of your sales price. That does count towards your total out-of-pocket expense, regardless if you're getting assistance or not. But that deposit is protected because you have a thing called the contingency period when you buy a house. And looking back at the Bay Area market, a lot of sellers weren't giving buyers the contingency opportunity because it was such a competitive market. And so a lot of buyers were being forced to make it, offers on homes, get them accepted, but they didn't have any contingency or way of protecting their deposit. That's changed quite a bit now. So now we're seeing appraisal contingencies in place, inspections, loan contingencies, and it's giving the buyer the opportunity to do their homework on the property. So the appraisal contingency is important because we want to make sure the house is worth what we're buying it for. The inspection contingency allows you to go out and do whatever inspections you feel need to be done on the house or what your realtor guides you to do. And then the loan contingency ensures that you're going to have your loan approved. And why that's important is because your deposit is completely protected during that contingency period. The contingency goes from day one of entering escrow to about as short as 10 days to 17 days into the escrow period, which will generally take us to like step 5. Step 4 is going to be processing and underwriting. That's where our team does all the administrative behind the scenes work on your loan, verifying your employment and your assets, getting any type of additional documentation that we think we're going to need to submit to the underwriters for review. And then we're going to get your rate locked in, usually by the time we get to your follow-up consultation, because the markets remain super volatile. So we want to make sure we get that all in place for you. Now, as a side note, with interest rate locks, especially on the first-time buyer program, we cannot register and lock you into the first-time buyer program until you have an accepted offer on a property. So that's kind of where that program works. So we have to be able to define a certain address or note a certain address to be able to register those funds. Okay, step 5 is going to be your loan approval. That's where an underwriter has approved your loan, and we've gotten some conditions of that approval. It also brings us to the end of your contingency period. So if you feel satisfied with the outcome of your appraisal, of course, your loan's approved and your inspections are okay, then you'll want to connect with your realtor to give the sign off to your contingencies. But you just want to make sure you feel really good about that, because if you sign off on your contingencies, and then maybe a couple of days later, you just get second thoughts about the property, you could risk losing your deposit. So you just want to make sure you feel comfortable with the house and all the kind of the outcomes of your reports before you make that sign off. As a lender, we're also going to deliver to you a final closing disclosure, and that needs to be e-signed by you, but it starts your 3-day cooling off period before you can sign final documents. It just gives you the added protection as a buyer that all the costs, the interest rate, the payment is in alignment with what you've seen in previous disclosures. So you're going to have your 3-day cooling off period. And now we're going to get to the finish line, which is step 6. And that's where you get a chance to sign your final documents. That's still the one step in the process that requires in-person signatures through a public notary. So that process will take usually about an hour to an hour and a half for an in-person signing. You'll be required to wire in any other funds that you have owed for the transaction. Once that's all been taken care of, the escrow team will reconcile those funds from you, as well as your financing, any assistance programs you're taking on. And then once that money is all balanced, so the seller's getting the expected funds that they're supposed to get as part of the contract, you've contributed what you have as a buyer. Documents will get recorded with the county recorder's office. They record a grant deed, and that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. And so once all that gets recorded, then you become the official owner of the home. You get a chance to high five and celebrate because you've made it to the end of this journey of home ownership. And this journey will have some ups and downs. It's obviously a very stressful time period, but we want to be to a team that helps support you through this process, because this is probably going to be one of the biggest investments you make in your lifetime. So we've heard a little bit about consultations this evening, and a consultation allows us to design a home buying plan for you. That enables us to connect with you for a 30-minute video or phone call session to design that plan and go over the process, talk about interest rates, different budgets, and kind of put you on that path towards home ownership with a pre-approval. The links to set up those consultations are all found here on this slide. We encourage you to submit your online application first and submit documents, which are all listed here, and we'll send those in a follow-up as well. But you can schedule your consultation. If you have some follow-up questions from today's session and you want to just do a quick, maybe 10-15 minute connection over phone, myself or our team's always available for that, because a lot of questions come out of these workshops that we can always field for you, especially some different scenarios that you want us to run for you. This is the framework of the consultation. So it's budgeting, it's talking about different sales prices of homes and the location of the desired area you're looking at, interest rates, closing costs. We'll do the debt to income ratio together, look at the process, and then of course, as you saw earlier, the output will be a pre-approval for you. Okay, and in the chat, Ken put up the link. So if you do want to take advantage of a consultation or get a chance to complete the online application, you can go ahead and do that as well. This is one of our great resources we have. It's our mobile app, and allows you to actually apply right there online through your mobile. You can upload documents. You can follow kind of the progress of your loan right through mobile. Also has a fantastic calculator. It's all calibrated to the different programs. So as you're out home searching, you can do a real-time payment calculation. You heard me mention a little bit earlier about our partnerships that we have. We love all of our different universities that we partner with throughout California, even some back on the East Coast. So if you've attended and are part of any of these alumni groups, we'd love to pass along our $750 discount program, as well as if you're a state employee, we have the same discount that we send along to you as well. all these consultations that we do for our clients every day are all free services we provide. Whether you're buying a house next month, next year, or 3 years from now, we just want to be a resource for you to help design a home buying plan for you. So there's no pressure to go out and buy a house right away. It's just understanding what your options look like. So when you do want to be on that path towards homeownership, you really have a great idea what it looks like. Now, we have workshops throughout the year, and you're more than welcome to join another workshop. If you have friends, family, some colleagues that would like to attend some of our upcoming classes, here's our schedule taking us all the way through October. The same class schedule can be found at mortgageeducate.com as well. And here's all my personal contact information. So if you want to reach out to me after tonight's class, you do have questions, feel free to connect with me. Or if you just want to schedule a consultation or even that intro call, we'd love to be able to meet up with you. We have some fantastic testimonials from our clients, and we love to share and celebrate home ownership. So check us out on some of our social channels. You can follow us on Instagram and Facebook. I think there's a lot of great information that we try to post out there, not just testimonials, but some of the updates on programs, especially some of the assistance programs that are available. And we really love what our clients are saying about us too. So please check us out on our Google reviews and our Yelp as well too. We have a lot of great things. Our clients, a lot of our graduates actually, they're talking about us from our workshops that we've conducted. So with that said, I know we're a little bit over our allotted time, but I want to leave it open for a few more questions to make sure we got everything taken care of for you this evening before we wrap up. So I'm going to keep us on air for a few minutes, and then we'll go ahead and sign off if we don't have any more questions.